For much of the last decade, growth was the dominant language of US tech. Companies were celebrated for expanding users, revenue, and market share as fast as possible, even if profits were nowhere in sight. Burning cash was not a flaw. It was often framed as a strategy. As long as growth curves pointed upward, losses were tolerated and sometimes even encouraged. Today, that mindset has fundamentally changed. Across the US tech sector, companies are shifting away from growth at all costs and toward cash flow discipline. And the reasons behind this shift reveal a deeper reset in how success is defined. The most obvious driver of this change is the cost of capital. For years, low interest rates made money cheap and abundant. Tech firms could raise large amounts of funding with minimal pressure to generate near-term cash flow. That environment no longer exists. Capital is more expensive, investors are more selective, and access to funding is no longer guaranteed. As a result, US tech companies are being forced to operate as if external capital may not always be available. Cash flow has become a survival metric, not just a financial detail. Investor expectations have shifted alongside capital markets. In the growth at all costs era, investors rewarded companies for expanding aggressively, even if margins were deeply negative. Today, investors are prioritizing sustainability, predictability, and financial control. They want to see that businesses can fund operations internally, manage expenses, and generate consistent cash flow. US tech executives are responding by restructuring budgets, cutting unprofitable initiatives, and focusing on core revenue streams rather than speculative expansion. Rising operating costs have also accelerated the move toward cash flow discipline. Cloud infrastructure, cybersecurity, compliance, and technical talent have all become more expensive. Many tech firms discovered that scaling revenue did not automatically improve margins because costs scaled just as fast. Growth that once looked impressive on paper often masked fragile economics underneath. Cash flow discipline forces companies to confront these realities by aligning growth with profitability rather than assuming efficiency will arrive later. Customer behavior has changed as well. During periods of rapid growth, tech companies often prioritized user acquisition over monetization. Discounts, freemium models, and aggressive pricing were used to drive adoption. Today, customers are more price-sensitive and more selective. US tech firms are placing greater emphasis on retaining profitable customers, improving lifetime value, and ensuring pricing reflects real costs. Cash flow discipline shifts focus from raw growth numbers to the quality of revenue being generated. Internal accountability is another important factor. Growth at all costs often allowed inefficiencies to persist. Teams expanded quickly, projects multiplied, and spending increased without rigorous oversight. Cash flow discipline introduces clearer accountability. Budgets are scrutinized, headcount growth is measured carefully, and initiatives are expected to justify their return. This changes internal culture, pushing teams to prioritize impact over activity. The shift is also reshaping product strategy. Instead of launching numerous experimental features to chase growth, US tech companies are focusing on improving existing products, increasing reliability, and deepening customer engagement. Features that generate clear value are prioritized, while those that add cost without meaningful returns are delayed or cancelled. Cash flow discipline encourages focus, reducing complexity and improving operational efficiency. Mergers and acquisitions are being approached differently as well. In the past, acquisitions were often used to accelerate growth or enter new markets quickly, regardless of integration cost. Today, deals are evaluated more cautiously. Companies are asking whether acquisitions will improve cash flow, strengthen core offerings, or reduce long-term costs. Growth alone is no longer sufficient justification. This shift has also changed how success is communicated. Instead of emphasizing user counts, total addressable markets, or future potential, US tech firms are highlighting free cash flow, margin improvement, and cost control. Earnings calls, investor presentations, and internal metrics increasingly reflect this new priority. The narrative has moved from expansion to endurance. Importantly, the move toward cash flow discipline does not mean growth has stopped. It means growth is being reframed. Sustainable growth is now preferred over rapid expansion that relies on continuous external funding. Companies are still investing, but those investments are more selective and more closely tied to measurable outcomes. Growth that strengthens cash flow is rewarded, while growth that weakens it is questioned. Workforce decisions also reflect this change. Hiring plans are more conservative, and roles are more tightly aligned with revenue generation or operational stability. US tech firms are placing greater emphasis on productivity and efficiency rather than sheer headcount expansion. This represents a significant cultural shift from earlier periods when rapid hiring was seen as a sign of momentum. Looking ahead, the shift from growth at all costs to cash flow discipline is likely to persist. Even if market conditions improve, the lessons learned during this transition will remain. Companies that can generate consistent cash flow have greater control over their futures. They can invest on their own terms, weather downturns, and avoid being forced into unfavorable decisions.